Welcome everyone to the Absentee Landlord webinar. Thank you so much again for joining us today. We're excited to present this valuable content to you, especially with the market being so crazy right now. It's always good to stay up to date and be educated around one of your most important assets, which is probably real estate if you're here today. My name is Carrie Gatto, and I'm a realtor with Keller Williams Cambridge. I'm at the Cambridge Somerville office, and I have over 10 years of experience. And I'm joined here today by my expert panel. We have Jamie Thompson with Thompson Realty, Emily Clare with Edward Jones, Sarah Hartline with McGurlis and Bloom, and Wolfgang Seuss with Great Point Capital today. And I'll introduce them in just a moment as we go. So today, the reason we put together this webinar is just to talk about and answer some of the bigger questions that come up for investors, landlords who already own property, whether it's one or several, and are thinking about when to sell, whether to sell, if they should continue holding, and if so, how to maximize their profit from this important investment. So some of the questions we'll discuss today will be, if I'm leaving the area, should I hold or should I sell the investment property that I have? Where am I going to find people I can trust to manage my property? Is it a good time to do this? Meaning either sell or hold, or even buy more and add to your portfolio. And what are the important numbers to think about before I make my decision? Are there other investment opportunities I might be able to take advantage of related to real estate investing? And if I do decide to do this, what do I need to know and how do I prepare? And would real estate investing be a viable retirement planning vehicle? And in order to properly answer all your questions, we have here today Jamie Thompson. He's a rental agent and property manager, and he'll talk about how to take the stress out of real estate. And myself, Carrie Gatto with Keller Williams Realty. My team is Big Picture Realty. I'll be talking about what the market's doing right now and some exit strategies to keep in mind as a real estate investor. And we have Wolfgang Seuss, who is a specialist in Delaware state trusts, and he'll be speaking about an option that you might not have thought about before regarding 1031 exchanges.
Was it Malia Ahmed? Yes. No, because we actually, he already paid for that. And we had a receipt for it. Yeah.
If you guys could mute yourself, if you don't mind, thank you. And Emily Clare is a financial advisor. She'll be speaking about the broad scope of your investments and your financial planning for retirement. And Sarah Margolis is an estate attorney, and she'll talk about the legal aspects of your estate as a whole. Okay, so now I'm actually going to stop my share, and I'm going to turn it over to Jamie, who's going to talk about property management and rentals. One moment, Jamie. Okay.
Good morning, everybody. My name is Jamie Thompson. I'm at Thompson Realty. We're located in Medford, just north of Boston. I'm going to quickly give you a market update. It's been an interesting year on the rental side of the business. This chart shows you where we are for November compared to last November. I just want to quickly jump down to the bottom though. What's been interesting for this year is we saw rent numbers near the city actually drop. Some levels, Cambridge, Everett, Chelsea, saw marginal decreases in the rents on the market. Arlington, Medford, Malden saw marginal increases, and then Woburn, Stoneham, Wakefield, and Melrose, and cities around 95 actually saw significant increases. What I do want to qualify that with is that's not all. Now it has now all balanced out. What we're seeing in the market is a change back to pre-pandemic pricing, pretty much across the board. We're seeing rents going up for existing tenants and rents on the market for listings up significantly. I've seen some places that are up almost 30% than where they've been this year. So we're definitely seeing, due to inventory, now if I'll jump up to the chart, this pulled last week. Compared to last year, we're down almost 1,500 units in the Middlesex area market. So we primarily cover Middlesex and Northern Suffolk. I do go into Boston as well. So the numbers that you see in Boston, this is all based on MLS inventory, which you see more activity in the North Shore. Boston has some other systems that they use for marketing. So pretty significant change compared to last year, especially because what we saw was a lot of units were vacant or rented earlier in the year this year than they normally would be. So you don't have a turnover cycle as strong as we would. Even we're in the winter season, so you don't entering the winter season, so you're going to see that drop off anyways. But this was significant compared to previous years. So average days on market due to the low inventory is dropping, and average list price is up. So again, we're seeing that increase in about 10% price increases compared to last year. And at this time last year, due to inventory, we also saw pre-pandemic prices. So that's not unexpected. But I can honestly say, I think we're going to see continued growth in rent prices and a return to normal going into next year. I think we've seen the brunt of everybody that left the area, and we're starting to see demand start to increase as things start to open back up and people come back into the city. So again, market impacts, low inventory. A lot of the units that we're seeing on the market have been updated. They may have been vacant for a couple of months, so the owners took the opportunities to update those units. Demand is slowing as we go into the winter, but that demand compared to the inventory is pushing prices up. Eviction moratoriums, the state and federal moratoriums have been pulled, but you are seeing some cities maintain their own moratoriums. And for assistance programs, if you've got renters that have trouble paying the rent right now, the Emergency Rent Assistance Program is a great program. That's the federal funding that's been presented that is run by the states. Boston Housing is managing that for Massachusetts, and tenants can get benefits to cover previous rent and up to 18 months of future rent if can show that they've been impacted by COVID. And again, for tenants that are moving, RAFT was up to $10,000 from $4,000 last year. And they are issuing additional housing vouchers for tenants in need. So number one priority from a property management perspective for us is to take the stress out of real estate management for you. Managing a property, you have tenants, you have maintenance, you have finances. There's a lot of activity that goes into that takes away from your normal routine and can interrupt your day-to-day activities where you've got emergency calls, you've got maintenance calls. So you've got maintenance calls that tenants think are emergencies that may not be. So our number one priority is to get a system in place to manage all of the activity that goes into your property so that you don't have to take care of that anymore. Our next activity is going to be optimizing your return on that investment. Number one way to do that is obviously to maintain occupancy, maintain market rents, and limit your expenses. Rents are going to be when we went through the pandemic location. How do I go back? There we go. When we went into the pandemic, location, train stations, Boston kind of got blown out of the water. That's coming back now. We're seeing a lot more demand again around the train stations, commuting and things like that. And I think we'll continue to see that as people move back into the area. Pricing again, based on number of bedrooms, the number of bedrooms is going to be a key price indicator. Layout, amenities, the quality and condition of the property. We're seeing a lot of pressure for owners to provide as many amenities as possible. You went from washer dryer hookup. Now you're in a scenario where tenants want washer dryer in the units. You may have had coin op in the basement. Tenants are looking for washer dryers in their units. If you had washer dryer hookups, it's definitely in each unit. It's definitely worth your while to include the washer and dryer and go up on your rents to support that. And then obviously the other side of your finances are the expenses and depreciation. Minimizing the amount of expenses on the property is primarily predicated by maintaining the property, keeping things up to date, doing a regular walkthrough of the property. We check in with tenants once a month. We do quarterly walkarounds of the entire property. You want to make sure that your management company is keeping eyes on the property, checking utilities, checking your basement, checking roof for leaks and things like that. That's where you're going to prevent the highest expenses that you may have to incur. And your third item is maintaining tenancy. As we've seen with the pandemic, vacancies are the most expensive hit to your finances after expenses. 1 month vacancy can, again, hits you for 1 month. If you have multiple months, you're going to be looking at loss of income and possible difficulty covering your expenses. The key to that is reducing the potential for turnover, keeping your tenants that are in the property comfortable. Again, your tenants it's your tenant's home, it is your house, and you have to look at it that way, keeping them comfortable and keeping things running so that they are happy where they are is a key to keeping tenants, and also being able to increment your rents. Knowing where your rent is compared to the market to be competitive, but also not jumping the rent to potentially push somebody out of the unit. Maintaining communication with the tenants, again, the maintenance request, the emergency request, and then also that educating tenants when something may not be an emergency, although they may think it is. And then again, responding to unplanned events, those emergency situations. I was just in a property today, letting plumbers in to clean a main drain. Knowing when being on top of those things and getting on them right away shows the tenants that you're taking care of the property and you're going to be there. That gives you the opportunity to increment your rents because they know things are going to get taken care of and their money's going to a good, other than just their space. So the 3 key points on the value of property management: you get your time back. You're not going to spend your time managing the property, the finances, the maintenance, juggling contractors, handling the communications with the tenants, getting back to them, forgetting to get back to them, and keeping that your time for you. Optimizing your return, again, keeping the rents at a market rate and reducing your expenses, keeping on top of maintenance are all going to be items that optimize your return on a cash flow basis, on a monthly basis, and as well as your return later on when you do decide to sell the property, you'll have a property in much better condition to get the value out of that. And the third item I always reinforce right now is investing in market amenities. The competition right now for rentals is very strong. Keeping your amenities in the unit, again, washer dryer availability in 2 bedrooms plus dishwashers are a big thing, especially if you're looking at roommate situations. Roommates don't want to decide who's going to buy appliances and who's going to move with them. They want the convenience to be there, and they're willing to pay for that. And to get in touch with me, I'm located in Medford. My number and email address are here. I'll put those into the chat for you, and I'll hand it back to Carrie.
Thank you so much, Jamie. It's great news that the rents have bounced back to pre-COVID levels, especially if you already own property. Okay, sorry, I'm just trying to share my screen again. Okay, can you guys see my screen?
Yep.
Okay, thank you. So that's really good information. And if you are thinking of holding or acquiring more property, that's excellent news. I'm going to talk about how to track your investment portfolio, and also on the sales side, how to maximize returns and possible exit strategies that you might think about as well. So on the market for sales, this is a chart that compares year over year. So this time last year to right now. And these are year-to-date numbers. So basically, what we're seeing in the market still, it's a hot seller's market, and it's a better seller's market than it was this time last year overall. And the things that determine that are things like how many listings have sold year to date. And what we're seeing is over 30% more listings have sold year to date in 2021 than in 2020, and this is just for multifamilies. So 30% more have gone under agreement, which means, they've had a signed PNS, signed purchase and sale agreement, and over 42% more have actually sold and closed, which is a big increase. The average sale price for multifamilies has gone up over 10% year over year. And I'm sure a lot of that has to do with the rentals bouncing back as well. As the income has come back, that has given more value back to the multifamily. We saw a slight dip during COVID when, the rentals were softening. And also at the same time, while sale prices have gone up, we have less active listings available on the market today. There are 14% less available multifamilies on the market than there were this time last year. So inventory is a little short, as you can see, and the month supply of inventory is just over 1 month, 1.5 months. So basically that means that the inventory we have available right now on the MLS could be absorbed by the buying demand in about 1.5 months, which is very tight. Anything less than 6 months is considered a seller's market. And the average days on market is also down from last year about 22%. So it's taking on average about 35 days for a multifamily to sell today in Massachusetts. So again, overall a hot market. Now, one of the things I help my investors do is I help them track their portfolio as far as the gross income, the operating expenses, the cash flow, the net income, and also return on investment. So I have Excel spreadsheets that make it really easy to do this, and basically just help you input the information that you need, helps you track your portfolio over time as maybe rents increase or expenses change, and therefore calculate your return on investment, which in turn helps you decide whether or not this is a good time to sell. Perhaps also in conversation with a financial planner, such as someone like Emily, that can help you manage your portfolio and your entire portfolio of investments on a broader scale, and how your real estate fits into that.
Over here, Duncan. Take a peek.
Achieve your goal. Oh, and by the way, those spreadsheets that I mentioned are also very helpful for when you're considering purchasing a property too. Helps you determine if it's a good fit for your investment criteria. Now, I wanted to mention that right now is also a great time to refinance. If you haven't refinanced in the past couple of years, I would definitely recommend talking to a mortgage broker. This is a great time to lock in a low rate.
Duncan, hurry up.
So can we have everybody muted, please? I don't know who's unmuted. Okay, yeah, so these historically low interest rates are only going to last for so long before they start edging up. Some people are saying that will happen next year. So again, just look at your interest rates on your properties and make sure that you have the best possible rate so you can lock it in. Money is cheap to borrow. You can increase your profit margins, perhaps free up cash or equity to buy another property. And even if you don't have a property in mind right now, there may be foreclosures coming down the road, as we know a lot of homeowners might have taken advantage of the forbearance period and might be coming out of that time, where they had the freedom to not pay their monthly mortgage payment, and now that kicks back in, they have to pay them. So there could be foreclosures coming as well. And to have the capital available would be a prudent idea. So if you can do that by refinancing, definitely a good idea. And another thing, as part of my service, I help you decide on upgrades. If you want to do things before selling, such as quick cosmetic touches or deferred maintenance, that could help boost your bottom line, I can help you make those kinds of choices. I'll just do a quick walkthrough. and give you a punch list of what would be the upgrades you could do to get the most bang for your buck. And these are always the most economical things. So I would never suggest like a complete renovation to sell the property, you know, unless you're talking about condo conversion, and I'll talk about that in a moment. But usually it's just very economical, efficient things that you could do that would boost the appeal of the property. And with investment property, it's not so much emotional appeal, it's more, it's probably more deferred maintenance or just boosting up the place to make sure that you, again, get the best possible price. And so a lot of landlords and investment property owners do ask me about condo conversion because we have such a hot condo market in the greater Boston area. And if it's not someone who's an experienced developer and it's like their first foray into condo conversion, I just want to make sure they have all the facts, because even though those condo prices can look very, very attractive, a lot of times would-be sellers or owners don't realize how much money went into those condos to make them look like that. So the high-end condo buyer, is definitely looking for very high-end finishes, absolutely move-in ready. They don't want to have to do anything once they move in. That's why they're paying those big prices. So to get those premium prices, just factor in that you're probably going to be paying something like $250 per square foot for renovations in most cases. It could take 1 to 2 or more years, depending on the policies and guidelines in your city or town. Somerville, for example, had an overhaul of the condo conversion process a few years back, and it actually made it so that it could take up to 7 years for a developer to finish a condo conversion. So just be aware of the timeline, because time is money. And if you're holding a property vacant over several years, that could really be a drain on your profit. And during COVID, the condo market did soften a little bit. It is coming back, but it is especially the high-end condo market can be a little bit precarious, just because people willing to pay, people who are able and willing to pay really high prices for a condo are less. It's a smaller buyer pool than someone who is in more like the first time buyer, 500K kind of ballpark. People are paying $1 million for a condo, for example. That's just a smaller target audience. So you just want to be aware if the economy shifts, if the market shifts. Usually it starts at the top and works its way down. So it's really hard to predict what the market will be like in 2 years. So you just want to make sure that you're able to absorb any market shift that might happen in the interim while you're doing your conversion. And lately, since COVID, urban areas have softened and people are more interested in the suburbs, even right now. Maybe that will change next year, but we don't know yet. So you just want to, again, be wary of what's going on in the market. If you are interested in doing a condo conversion, just to finish that portion up, definitely reach out to me and I can walk you through what is the market like for your specific area, and what, I can do a market report for what your property would be worth as a condo and what it would be worth as is the multifamily. So you can look at both and compare. And 1031 like-kind exchanges. If you are thinking of selling an investment property, you're probably also thinking about the taxes that could come with that. Capital gains is top of every investor's mind these days. So, and Wolfgang Cease is going to talk about a way to, a thing that you haven't maybe thought of, a way to reinvest part of the proceeds of the sale or all of them, so that you can defer your taxes. And a 1031 exchange is just that. It means that you can exchange one property for another real estate property. That's why it's like kind, because it has to be real estate. And you can actually defer part or all of the capital gains that would otherwise be due with that sale. So there's definitely some timeframes to keep in mind by the IRS, and Wolfgang will expand on that. And one thing I recommend is to make sure that the sale of your existing property is subject to finding a replacement property. And that's especially important in a seller's market because right now it's easier to sell than it is to find a new property. So if you have that contingency, it protects you from not being able to find your replacement property in the right time frame. But again, it all starts with a simple consultation. Let's figure out what your property is worth and how to maximize your bottom line, and if it makes sense for you to do that right now. So feel free to reach out. That's my email, my cell phone number, and I'll also put it in the chat, and I'd be happy to have a conversation. And now I'm going to turn it over to Wolfgang.
Thanks, Carrie. Can everybody see my screen? Perfect, perfect, perfect. All right, so thanks for the intro, Carrie, and always appreciate everybody inviting me to this quarterly roundtable. My name is Wolfgang Cease. I run Great Point Capital's operations on the East Coast, specifically New England. And I'm going to talk about a few things today. Who's Great Point? You know, what is a Delaware statutory trust, estate planning, what's a typical DST investor profile, and some case studies along with that, if one case study, if time permits. So who is Great Point Capital? We are based in Chicago. Boutique investment banking firm. It's founded in 2000. We specialize in tax deferral strategies, specifically passive solutions for 1031 exchanges, passive vehicles that are called Delaware Statutory Trusts. I also do quite a lot of business in the Opportunity Zone Fund, which is another tax deferral strategy in case you miss deadlines on a 1031 or you're selling another asset for a gain. Our primary, the primary client of mine is a high net worth real estate investor who is looking for ways to defer his or her capital gains tax. And so they come to our firm, and we have a slew of opportunities to do that, vehicles to do that. We also have an investment banking department and a trading group. So again, who am I? Wolfgang Cease. I run our operations out here. I live in Beacon Hill and also work out of the Beacon Hill neighborhood. I call myself a brick and mortar financial advisor. I'm in the securities business, but as I mentioned, all my clients are high net worth real estate investors or just real estate investors looking to kick the tax burden down the road. I'm an expert in 1031 exchanges, specifically Delaware statutory trusts and opportunity zone funds. I'm also a landlord and real estate investor. I've got some units that I manage in a few states, and I've done 1031s personally myself. You know, this is a quick slide about real estate markets and specifically commercial real estate markets. We have rebounded substantially since the financial crisis of 08-09, as well as the pandemic, as both Jamie and Carrie had mentioned. We have come back. There's still some sore spots such as hospitality and shopping centers, but for the most part, we are at all-time highs across the real estate board. What is a 1031 exchange? Carrie kind of mentioned this and talked about this for a second. A 1031 exchange is a like-kind exchange that gives an investor the opportunity to kick the tax burden down the road and defer capital gains taxes due on both the federal, state level, as well as there's a 3.8% Medicare investment tax, as well as depreciation recapture. So I will talk a minute about So here's an example of two people. One person is doing an exchange, the other person is not. Scenario A, they're just going to pay their taxes, bought a place for 400 grand, sold it for 1.1 million. They've got long-term capital gains of 140,000. State taxes would actually be in Massachusetts, for instance. I have that blank because I'm not sure what everybody's primary residence is, but that'd be another 60,000. Net income tax, as I mentioned, the Medicare tax, 36,000. Depreciation recapture, everybody forgets about that, 62,500. For total taxes due, if you're a Massachusetts resident, it'd actually be closer to 300,000, and your net proceeds would be closer to 800,000. Whereas if you did an exchange, you would be able to redeploy the whole $1.1 million sales price that you had. So what qualifies for an exchange? Rental property, commercial real estate, raw land, business real estate, certain fractional indirect ownership units such as Delaware Statutory Trust. All right, what can you not exchange? What does this not include? Stocks, bonds, properties purchased for resale, fix and flips. Remember, this is all long-term capital gains. So if you buy something and sell it 3 months later, it does not count. Primary residences are not allowed to be exchanged, nor are real estate investment trusts. Timeline that Carrie mentioned, day 0 is the close of your property. You have to identify what you're going to exchange into by day 45, and you have to close on that by day 180. Please keep in mind, if day 45 or 180 are on a weekend or a holiday, the IRS doesn't care. You have to have it done prior to that day. So there's 3 rules of a 1031 exchange. You sell a place for $1 million, you have to buy a place for $1 million or higher. So you have to replace value. If you sell a place for $1 million and you had $500,000 of equity and $500,000 of debt, you have to, when you buy it, when you exchange into the new property, you have to replace that equity, which would be 500,000, and you would have to replace, rule number 3 is you have to replace debt. So whatever your mortgage is when you sell, you have to replace that on the exchange. There's 3 rules that you have to abide by in the 45-day ID period. 3 rules that you can pick from. The first one is the 3 property rule. You can identify 3 properties and pick any or all of them to exchange into. The second rule is the 200% rule. You can identify as many properties as you would like, but up to 200% of the value of the property you sold. So if you sold something for $1 million, you could identify as many properties as you would like, up to $2 million, and close on any or all of those assets. And third, which I've never seen in practice, is the 95% rule. That means you can ID any amount of properties, but you have to close on 95% of them. In theory and in practice, it's a little bit different. In theory, the 95% rule is never used. I've never heard of it being used. Numbers 1 and 2, the 200% rule and the 3 property rule, I see all the time. So Delaware Statutory Trust, the 1031 has been around for 100 years. Believe it or not, it's celebrated its 100-year birthday this year. The DST, the Delaware Statutory Trust, has only been around for 17 years. What is a DST? It's an institutional grade asset. It's run by an institution. It's completely passive. It's stabilized. And you can exchange in fractional ownership units. We have a menu of DSTs that have everything from all cash transactions to 87% debt or LTV transactions. So as I said, you have to replace debt. So we can blend a portfolio to replace your debt. DST characteristics, as I said, completely passive. You're sick of the tenants, toilets, and trash. So you want to get out of the business. You've got a nice gain. You want to benefit from the expertise of institutional ownership. The debt on DSTs is non-recourse. So let's go back to that example of $1 million sale with $500,000 debt. If you did exchange into a DST, that debt would now, it would satisfy the IRS requirements, but the debt would be off your balance sheet and off your credit report. You can also diversify. A lot of the minimums on DSTs are $50,000. So you can diversify into different sectors and different geographic regions across the country. It's not a blind pool. They are not raising money. I'll go into this in the next slide. And when you sell a DST, when the institution sells a DST, the institutional asset, you are not married to the DST structure. You can pay your taxes. You can do another DST. You can call carry and buy an investment property. So you are not married to the DST structure. Here's just a hypothetical of how a DST is put together. A sponsor such as an Inland Private Capital or a Cantor Fitzgerald will go out and buy an asset. You will know at that time what type of asset it is, the address, the tenant, the financing terms, the lease terms, all the risks and disclosures. And if they don't, so they'll go out, in this case, it's a 328 unit Class A multifamily that they purchased for 80 million. If they do not, what happens is they'll go out and buy it. Attorneys will turn it into a Delaware statutory trust, and then they'll sell fractional ownerships to people exchanging, doing 1031 exchanges. If they do not sell fractional ownerships, they'll just own the asset. So it's not a blind pool. They're more than happy to own the asset, but their intention is to sell fractional ownerships. A DST investor profile, as I mentioned, somebody that's owned appreciated assets. Maybe they're doing estate planning. This is a great tool for estate planning. And it's very easily divisible if somebody passes away. I work with a lot of older people that have owned appreciated assets, and they want an easier way if something happens to them for their children to split up the estate. You know, it could be somebody looking towards retirement and they're, again, sick of the tenants' toilets trash. Somebody looking for completely passive cash flow. Maybe somebody that, you know, I'm working with somebody right now selling 16 condos in Boston, and they're diversifying into DSTs in Texas and Florida. So somebody looking to diversify out that is very, they have most of their assets in one area and they want to spread them around. And then 1031 exchange options. As Carrie mentioned, it's a very robust market and it's very hard to find properties to exchange into. So they have this in their back pocket and they use this as a tool to exchange into. Here's a typical, we usually have 40 to 50 DSTs in our platform. These are just a few examples of a hypothetical menu. Again, we've got portfolios of net retail assets. We've got distribution centers. You know, still Class A and Class B multifamily assets are the darling of the bunch, and they are represent about 50% of the business I do. So people still do gravitate towards the multifamily. We've got portfolios of self-storage. We've got office. We've got senior living facilities. We've got medical office properties, etc. And I'll leave you guys with a case study. So this was a couple we worked with, several years ago. The husband had a health scare, 71-year-old couple. The husband recently had a health scare. They got a child in the 50s that has absolutely no interest in getting into the family business. They had a $100 million real estate portfolio that they built up themselves, developed themselves, and managed themselves. As I mentioned, the one child has no interest in managing or being involved in the family business. And they just received an appealing offer on one of the assets that would cause a huge taxable event. We put a portfolio, we blended together both the sale was $20,750,000, and they had $11,250 of that was in debt, so 54% LTV. We built them a nice portfolio that was kicking off a nice monthly income And I'd like to mention that the monthly income from DSTs is generally tax sheltered for the most part. And they are extremely happy, and they're looking to do this strategy with the rest of the assets in their portfolio as they find buyers for these assets. And again, I appreciate your time. Feel free to reach out. My name is Wolfgang Cease, Senior Vice President in New England of Great Point Capital. And I would also like to say one last thing is that when you're doing a large transaction, the most important thing is to have a great team in place. You're only as strong as your team, and everybody on this call would be an asset to anybody selling an asset or considering doing an exchange. And estate planning, financial planning, this is basically a dream team on this call right now. So you're only as strong as your team, and thank you again.
Okay, thank you. I'll just, I think Wolfgang, when you stop sharing your screen, I'll share mine.
Yep,
Okay,
perfect.
Here we go. And, okay. Trying to get this to expand. Okay, well, I'm just going to show it like this. I'm having trouble expanding it. So today, so my name is Emily Claire. I'm a financial advisor at Edward Jones in the North End. And we were talking about 100 years since the Delaware, the 1031 exchange existed. I work at Edward Jones, and we are going to celebrate our 100-year anniversary next year. And what I want to talk to you about is, you know, you've got a lot of great people here. Carrie can help you with finding your real estate investment and understanding how to do that wisely. Jamie can help you manage that investment. I think he talked about the importance of having an emergency fund. I'm going to reinforce that. Wolfgang can help you with tax concerns as you are tax considerations if you're making a sell. And then, you know, what I do is help you contextualize this, what you're doing in real estate with the broader picture of your overall investment plan and your personal goals for what you want out of life. So my question to you is, why is it you're wanting to invest in real estate? What is it you want out of that? And what else do you want out of your life? That's what I'm here to help you figure out. And then I partner very strongly with somebody like Sarah. In fact, she's really been a great help to a couple of my clients recently because estate planning is a very important part of that too. And my goal is to help you build, protect, and transition your wealth, but really to accomplish what matters most to you. So again, looking at the big picture in the larger context of what you're trying to achieve. And I'm not really sure why my computer is acting this way where I can't show the whole thing, but let me just do that. Okay, that's a little bit better. So some of the main areas that I help clients that they're trying to achieve in their life are preparing for retirement, living in retirement, paying for education, preparing for the unexpected, and planning your estate or inheritance. So when it comes to preparing for your retirement, real estate may be a really important part of that strategy. You're building up a rental income properties. You're maybe planning to sell a property, liquidate it for retirement, whatever it is you're trying to do. You want to understand that in a bigger picture. And I would suggest it makes sense to add some liquid investments alongside your real property investments, because when there are unexpected events in the market, you want to have some liquid investments to diversify your strategy. So my area of expertise is really helping with the financial plan and looking at everything together. What is your mortgage, your real estate, your emergency cash, your how much are you saving for retirement? Do you have a 401k plan? All of that together. And to make sure that you're diversified in that strategy. I think real estate's an excellent way to build your wealth. It has been a very successful plan for a lot of my clients, but you also want to have some other kinds of investments alongside of it to give you more flexibility and diversification. Living in retirement, again, you might be living on your rental income. That's a great way to live in retirement. You may also have some other investments that you're managing and to build some other kinds of growth into your strategy. Paying for education, that's also something I help clients with. I'm not going to get as deeply into that, but there are lots of ways to do that, including tax sheltered ways on all of these. Preparing for the unexpected. So again, reinforcing what Jamie had on one of his slides about having an emergency fund, that is very important. Also having life insurance, having your disability insurance in order, long-term care planning, all of those areas I can help you with. You can also use life insurance as an estate planning tool. And so I can partner with your estate planner, Sarah's here on the call, to make sure that when you're transitioning your wealth to be it the next generation or charitable fund that you want to give to, whatever it is you're wanting to do, that you do that in the most tax efficient manner and that you're able to equalize your estate. So that's something that I can use life insurance as a tool to use, for example. So all of these are tools in my tool belt that I bring forward for you. We do have things like a charitable donor advised fund as well. That's new here at Edward Jones. So what I would say is when you think about your future and what it is you want out of life, I love that Carrie is not just focusing on real estate, but she's focusing on how can you build your wealth and achieve your personal goals using real estate. And I'd say if you want a financial coach to help you with that along the way and look at all the different pieces and be sort of a connector between the different members of your team, that's the role that I like to play for my clients. So just moving on, here's the process that I use. So usually if somebody wants to have a conversation, we start with a high level call just to see if it's a good fit to proceed into a deeper dive. And then we're going to take a look at your assets, your liabilities, and your vision for the future. And we're going to see where you are now. Then we're going to talk about if you're on track or you need to change that. Maybe you're not quite saving enough. Maybe there's some risk areas you haven't addressed. And then we're going to talk about a plan to get there. And what I usually am helping people with is the investment side of it in the non-real estate area. So, am I going to do an IRA? Am I going to have non-qualified investments like stocks or bonds or mutual funds or ETFs? So all of the regular kinds of investments that we've all heard about in the stock market. What I also want to mention is, a lot of times cash reserves are a concern for real estate investors. And I just had a client who he's buying a rental property, and he was originally going to sell his second property and then buy a new property. And instead he's buying another property without selling, and he's going to rent it out. And he has a temporary cash flow need where he needs to generate more money for the down payment than he had expected. And luckily for him, he has a fair amount of non-qualified investments, so not in an IRA. And we were able to do a margin loan for him that he's going to pay off within a year. So you are also able to generate some cash from your investments without selling them or having a taxable event. And that is sometimes a good short-term solution for transactions in real estate that I can offer clients who have investments. So anyway, once you're doing all of this, but the most important value that I offer is the ongoing relationship. So my clients, it's a long-term relationship, and I provide ongoing coaching and revision of the financial plan. You were going to sell the property and buy a new one, and now instead you're buying a new one and renting it out, and you're keeping the old property. That's a shift to your financial plan. You might want to revisit how that impacts your budget, your cash flow, and your overall long-term plan. And that's something I can do for you. So not to get too far into the weeds here, I will just mention it's pretty easy to get quality investments out there. That's not that hard to find. But if you're not sure if you're going to know which ones are quality, Edward Jones does the work for us. It vets out the investments and keeps out the stuff that is too risky for our clients. And also I then customize the portfolio to your specific needs and goals. So, that way, you're invested the way the right way? And also, what if the market goes down? I'm here to talk you through that and help you take advantage of that as an opportunity rather than seeing it as something to be afraid of. So just like a lot of people have been doing in real estate these last years. So again, it's the ongoing relationship that's valuable. And then let's go back to the team. So everyone in this call is part of my team. I'm going to be, connecting you with them if there's a need, and connecting my clients with them if there's a need. But my core team tends to be, here you are, here's me. I've got the Edward Jones home office supporting me with all of their expertise, and my branch office administrator, Laura. And then I'm going to partner with your CPA, your estate planner, could be Sarah. I'm going to partner with whoever it is you need. Sometimes I'm referring people to mortgage lenders because, like Carrie was mentioning, I'm looking at their mortgage rate and I can tell that they didn't refinance yet. So I'm saying, look at refinancing. And so those conversations, I'm going to connect you with people that you need to talk to and partner with them as a team. And bottom line is I'm here to understand what's most important to you. We'll use an established process to build a personalized strategy to help you achieve your goals. And we'll partner together throughout your life to help you keep on track. So that's my work for my clients. And here is my contact information. And I'm going to just put that in the chat right now. And I'll pass this on to Sarah, who I will strongly recommend as somebody who has been of great value to some of my clients. And I really trust her with them.
Thank you, Emily. I'm going to pull up my screen. Okay. Can everyone see that? Yes, great. Okay, hi everyone. Sarah Hartline. I'm an estate planning attorney with Margolis & Bloom. I know we're sort of at the end and I'm also a little under the weather, so I will go pretty quickly and just give some big picture points in terms of estate planning. So the importance of estate planning, as estate planners, we recommend reviewing your plan every 5 years or anytime there's a major life transition. Buying or selling real estate, always a good time to check in with your estate planning attorney or a good reason to start estate planning if it's something that has been on your to-do list. I won't go into the details, the nuts and bolts of estate planning documents today. We've got a lot of great materials on our website that explain those different documents, wills and trusts, and the different types of planning that you can do. But I will just talk about some of the common traps that we see for landlords. For example, overly relying on insurance for asset protection. Many of our clients that have rental properties choose instead to title real estate in an LLC. And that's something that I will work with clients to compare and contrast the LLC model versus using insurance for asset protection purposes. Also failing to have a clear plan as to how children or other heirs are going to take on in terms of managing the real estate. As Wolfgang had mentioned, sometimes children don't want to have anything to do with this. And other times children do want to have a huge role in managing real estate for parents as the next generation. So getting a clear plan and putting together documents accordingly. And similarly, the disconnect between your plans and what your heirs want. So sometimes people will assume that real estate will continue for generations after their passing, whereas heirs would prefer to sell real estate. So it's important to know the different tax and planning implications of those various different paths. So related to that, that ties into how you title your property. Do you title it in individual names, joint names, a trust, an LLC? Unfortunately, these are all issues that often don't come up until after, till I'm actually dealing with the probate side of things. So somebody has passed and their family is trying to figure these things out. And often these titling decisions excuse me, may not have really been thought through. So this just goes over, the LLC versus the trust process, certainly different steps that are involved. And most importantly, though, very important, not only to set up these documents, but also administer them correctly in order to get the protections. Big picture takeaway is that one size does not fit all. So whether, making these choices LLC versus trust, some people actually use an LLC with the trust as the LLC manager. But, just doing the same thing as your friend or your neighbor did doesn't always make sense. You need to look at your other assets, your goals, think about tax planning. In Massachusetts, we do have a very low estate tax exemption of $1 million. So very easy for anyone that owns real estate to quickly get over that. And then, the tax planning is going to play a role in these decisions that you make. Our office, like many other offices, does operate 100% virtually. So I do encourage people now is a good time to set up a Zoom, to have that call. Often clients will bring their family in, whether it's, adult children or other important players, their financial advisor, into that Zoom call to talk about these things, to have a better understanding of the issues, to ask questions. I have my contact information here. Feel free to reach out. I have my phone number or email, and I'd be happy to talk to you about your specific situation. So thank you, and I will pass it back to Carrie.
Thank you so much, Sarah. Well, we are up against the hour. However, I am available here today if anybody has any questions, at least for a few more minutes. And we have a dream team here today, as Wolfgang was saying, whether you want to hold, sell or increase your portfolio. So if anyone has any questions, you can feel free to unmute yourself or use the chat, and we're here for you. And I just want to thank all of our panelists today. You guys, I'm so honored to be in business with you, and you're all terrific resources and experts in your field. Thank you. I always learn a lot from the panel.
Thank you, Carrie. And I want to say, Carrie wrote a very short book on buying real estate that I read, and I have to say thank you to Carrie, because I bought my first home after reading that book with Carrie, and I think really that book helped me get over that, the inability to make that decision that I had before and make it a possibility. So I just want to say that.
Thank you so much. Yep, it's available on Amazon, or I can send it out to you as well, but it's called You Can Have It All with Real Estate. Great. So Sarah put her information in the chat, and I definitely want to encourage everyone. Everyone's situation is specific and unique, so I encourage all of you to reach out to all of us or any of us that would be helpful, one-to-one, where we all do free consultations. And I will email out tomorrow or later today even a link to the recording, as well as everyone's contact information. So again, just feel free to email or call and connect. The name of the book is You Can Have It All with Real Estate. And it's mostly geared toward amateur investors. Yeah. Thank you so much.
Thank you, Carrie.
Thanks, Carrie, for putting this together and keeping it going.
Yep.
You are welcome. It's my pleasure. And in case anyone's interested, on my YouTube channel, there are recordings of other past webinars as well. So feel free to check those out.
Now we need to book our night out.
Yes.
Yeah, we do. That would be really fun. Awesome. Well, it looks like everyone is okay for now, but again, hope to connect with you one-to-one, and hope you all have a great rest of your day. Thanks for your time.
Great.
Bye.
Thanks, everybody.
Thanks, everybody.